Hello, I'm your host, Mike Gelb, and this is the Consumer VC Podcast, where we discuss the intersection of venture capital and consumer innovation. If you're enjoying this show, also subscribe to my newsletter at theconsumervc.com, where you're going to receive all episodes straight to your inbox, as well as a weekly recap of all the consumer deals that are happening. All content and episodes are for informational and entertainment purposes only and is not investment advice. Before we get into today's episode, I want to tell you about A-Venture, a new platform that's about to launch that's making venture capital available to the masses. It doesn't matter if you're accredited or non-accredited, A-Venture provides an opportunity to diversify your investment portfolio and invest in private funds. If you're a fund manager, the A-Venture app also provides everything you need in order to make startup investments, including extensive research materials, seamless transaction processes, and allocation measures so you can properly diversify your portfolio. Now, typically, venture capital and startup investments are liquid, which is a major pain point for our industry. A-Venture is fixing this by offering periodic withdrawals for its investors. I and many others in this industry are so excited about this launch. They are preparing to list their first fund in the beginning of next year. So if you want to be the first to know, join their waitlist at aventure.vc. Thank you, Deb Benton, for introducing me to our guest today, Carle Stenmark, who's a general partner at VMG. VMG, short for Velocity Made Good, is one of the premier consumer private equity firms known for their investments in Kind, Quest Nutrition, Sunbum, and Justin's. However, Carle leads VMG's technology practice, and recently the firm went through a bit of a rebrand, which we will discuss. This conversation is about what types of technology companies VMG invests in and why they invest in technology. Without further ado, here's Carle. Carle, thanks so much for being here. How are you?
Doing well. Thanks for having me.
Oh, it's an absolute pleasure. Thanks for taking the time. Want to start from the very beginning. What was your initial attraction to consumer investing? Were you always interested in consumer growing up?
Uh, Funny enough, I actually was attracted to VMG not because of its consumer focus, but was more attracted to its philosophy around value add to its portfolio companies. So I had started my career at Summit Partners, worked there for 3 years, then went to business school with the aspirations of kind of moving to the operating side. Tried a summer in that role and realized, hey, maybe investing is more for me. And then when I was looking to get back into it, trying to find a firm that was really focused on spending a lot of time with its portfolio. To me, what was going to be the most rewarding was having a small piece in the journey that is building a company. And so when I joined VMG, which was 2012, I think we had 12 portfolio companies. The bulk of our time was actually spent with the management teams that we invested in. And, that allowed us, because we were so specific on investing in CPG, we had, inherent a lot of pattern recognition and could provide, in our opinion, more value given the specialization to the management teams we partnered with. And frankly, I think if you talk to our team, that's the most rewarding piece of our job rather than just hunting and finding new deals.
You said you originally, after you worked at Summit Partners and went back for business school, you were interested in being an operator or in joining a company. Why did you then transition back to, okay, actually, I think that I, was an investor. I am an investor or want to get back into investing, but be part of a firm that maybe must be much more hands-on with their portfolio companies. So you're not quite an operator, but you're very much maybe more part, you're more active or part of the business. Why move back to investing? Why not operating?
Yeah, I think, listen, I think it's a part of the function of what you've been exposed to. And so I had the opportunity to work with an amazing team at O-Power. I think the role that I was in was kind of more business development and sales. And I think I loved being a part of the business and thinking about new products, but selling into utilities is a very long, painful sales cycle. And so, I think naturally, after experiencing some of that long sales cycle of trying to sell into large public utility companies, I miss the high-paced nature of investing and the ability to dive deep into a lot of different industries, or not industries, but excuse me, into a bunch of different companies, but still in a fashion that, we played a very active role in the direction those businesses were going. And, I'll never forget it. I think it was the same day that I got engaged was when we sold the first portfolio company that I was a part of from the very beginning to the exit, and receiving that phone call from Kevin Schwartz, the CEO of VMG Makes, just thanking me, for the work that I've done and for changing his life, his family's lives, and all the employees' lives at VMG Makes, who are all shareholders of that business. Kind of chills still just thinking about it. And I think this industry and role can be very much a grind. But working towards those types of phone calls and those types of exits is, definitely what makes it worth it.
Totally, totally. I mean, I can only imagine receiving that call after a successful exit happened, and of course being part of that journey, and working pretty close with the founder, and obviously thanking you for all you've done for the business. So that's incredible. What about the VMG philosophy? You said that it wasn't so much consumer that attracted you to in CPG that it kind of attracted you to investing in CPG. It was really actually working that you wanted to work at VMG, or that you really liked about VMG. What about VMG kind of made it special for you?
Yeah, I mean, I think when I joined, the team was very small and very collaborative, and so I worked at a very large shop, a very successful one, but wasn't a part of all the sausage making, and so I think as I looked to get into this career, wanted to have a seat around the table, and for a good portion of when I joined. Um, we had a small round table because we were a team of 7 or 8 people, where we made all the decisions together. And I think having that level of transparency helped me not only become a better investor, but equally as important, just a better board member, a better advisor, because it was kind of learning a lot from my colleagues on, how they thought about building businesses and how I was getting exposure, not just to the portfolio companies I was responsible for, but getting a lot of exposure to every single company that VMG was a part of. And so I think that type of collaborative team nature and in-depth, kind of portfolio analysis was what was really attractive.
No, I mean, that makes a lot of sense. And also thanks for sharing kind of the differences to your previous experiences, working in, a different, maybe a non-collaborative or just a different work environment to VMG, and kind of how some of the funds operate just a little bit differently. Um, a few years ago, VMG then introduces, VMG Catalyst, and identifies, wants to invest in more technology companies. In addition, of course, to maybe the main business of VMG, which is what I know VMG for, which is our the Kind bars, the Quests, the Sun Bums, and what you have you right. That's what you kind of know VMG for. And so, what was talk to me about like the beginnings of VMG Catalyst, and how and why it made sense to launch a fund, and as well as you joining that initiative.
Yeah, absolutely. And I mean, and it's evolved a lot over time. So we can talk about that as part number two. But, to begin, what was the impetus for VMG Catalyst, soon to be VMG Technology? It was really seeing a gap in the market for capital available to more tech forward consumer brands. And what we were noticing is just, consumer expectations were only increasing. Obviously, Amazon is a big reason why. And then you had social media really allowing a number of companies to reach consumers faster and more cost effectively. Ultimately, you start having more complicated supply chains. But what what was the initial attraction was, these tech forward consumer businesses who were being built online first and then slowly moving offline, didn't have capital available to them that was very consumer specific. And especially at the early stages, I think you saw a lot more of these businesses being funded by traditional venture capitalists. And I think to us, was forcing these businesses to take on more money and grow faster than what was right for the business or the brand. And then ultimately, what our belief is, what was right for the founder. We've now had the pleasure of selling a lot of our portfolio companies. And I think what makes consumers so attractive, especially in a market like we're facing right now, is that the best consumer brands, engender a lot of evangelism and create tons of word of mouth marketing, which then result in very profitable business models. And so a lot of times when you're going to sell these businesses, you hear a lot about revenue multiples. What you hear less about, but is probably more important, is actually the EBITDA or the DCF that allowed these acquirers to get to that revenue multiple. And so we felt there really needed to be a capital provider in the market that was willing to play a little earlier, because our consumer or growth practice was usually coming in when businesses were 10, 20, 30, 40, now even a little bit larger to start with. And, could we find those, Series A businesses in traditional venture language that we could still scale capital efficiently and still take that consumer-centric, brand-centric mindset to investing versus looking at, 3-year LTV over CACs and telling teams to spend a lot more into paid, knowing that, there's no switching costs in consumer. You can't really look at 3-year LTVs because, you're entering into a contract that at each time a consumer decides to buy a product, for 2 or 3 years. And so I think the way you need to operate these businesses is slightly different than the way you would operate a technology company that is just a lot more sticky, or that is signing 2 to 3 year contracts.
Has that been challenging for you to make that adjustment from investing in pure CPG companies at a different stage, later stage, and where you also have maybe real revenue, whereas you're investing maybe earlier now, right, at maybe like the Series A stage in technology companies, since, as you said, the model is so different?
Yeah, and it has been a change, and maybe I'll give a little bit of context because we started to talk about the impetus of Catalyst being more around digitally native brands that were starting online first and then scaling off channel. I think our belief at VMG was very quickly that the best brands are where the consumers want them to be, and that's typically your consumer dictates your distribution, not your business model. And so we've always been big believers in omni-channel distribution. So you have e-commerce, but you also have traditional retail. And because of that, we quickly came to the realization that we could just invest a little earlier from our consumer or growth fund, and help these businesses that started maybe first online, navigate this omni-channel dilemma. That then led our Catalyst and now VMG Technology Fund to also make a shift. And so what you will no longer see VMG Technology or Catalyst do is investing in direct to consumer businesses. we're really focused on investing, to your point, in the technology that will support the consumer ecosystem. So that's typically brands, whether they be emerging brands in the VMG portfolio or the large conglomerates that are one day purchasing those brands, the retailers that sell those businesses, or increasingly a lot of the consumer services verticals that we are now starting to play in on the consumer side. We will also invest in marketplaces, both B2C and B2B, on VMG Catalyst, now VMG Technology. And so, to your point, that is the shift we've had to make is, especially me, the rest of our team on VMG Technology has been SaaS investors their whole career. The transition from me being a consumer to more of a software investor has been one where, I think some of the acronyms are different and some of the ways that you're able to invest in the infrastructure to then see those rewards, a year or two later is definitely different. But I think we're still looking for the same fundamentals in what's inherently a great business model. Your gross margin benchmarks are definitely different. But, in terms of your go-to-market efficiency, there's actually a lot more similarities than one would think. And especially as you're seeing just this general trend towards the consumerization of software, the end user of these products is so critical that taking that lens is very important. And so where we saw the gap in VMG Technology going forward was that, historically, most software businesses that everybody's aware of and that has made, the venture industry a lot of dollars have sold into other technology verticals. Because, I've taken and the team has taken such an active role in helping scale our consumer businesses, we've also had a front row seat into so many of the pain points that face those businesses as well as their distribution partners. And, again, our belief is that while we're early on the adoption curve of technology, these consumer verticals will have to invest more in technology going forward to serve the increasing expectations of its consumers, as well as to manage the complexity of today's ecosystem to scale revenue non-linearly with headcount. And so we come at it very much as an approach of what pain point is this software solving, then using our VMG ecosystem to identify the willingness to pay and the criticality of that pain point. And then we use that to help influence our investment decisions on going into a business. And then on the flip side, post-close, we use that same ecosystem to be very helpful with our entrepreneurs as they think about their product roadmap and their go-to-market strategy.
So I understand that kind of part of this evolution and kind of that shift from, catalyst to technology is realizing that brands, that digitally native brands, even though they're digitally native, eventually they're going to have to scale kind of in retail in the store. So it makes sense to actually put them on VMG consumer side instead of the technology side. Is that roughly right?
That's correct. Yep.
Cool. What about something like We though, which is, a online grocery company? Would that fall under technology or would that fall under consumer?
Yeah, Mike, you're really always asking the hard question. That's why we like you. No, I think that would fall under technology going forward. And so, it is more of an or online retailer, today. I think we kind of view it in that marketplace bucket. And they are building a marketplace alongside their retail business that's kind of similar to Fulfilled by Amazon. And so that's why we would put it more into that bucket. But again, I think why We is interesting is that we can use a lot of our learnings on consumer to be helpful with them. But, we can also really be thoughtful on marketplace and more consumer marketplace economics as we think about scaling and so they hold inventory, they have warehouses, they have distribution, and so there's just a lot of blocking and tackling and execution of moving groceries around that is quite complex, that we're actually quite used to on the consumer side. But as we think about scaling, we think that is more akin to consumer marketplace than it is a consumer CPG brand or consumer services company.
No, that makes sense. That makes sense in terms of where kind of we would, because I saw the rebrand and just was kind of one of my first thoughts that came to mind was where does kind of we kind of fit in terms of if it's on the consumer side or the technology side, because it is obviously a consumer business.
I think you're right. It's the one that's probably the most challenging right now, given that it's the vast majority of its volume is from direct retail in the sense that that they own the inventory, and so you can make an argument that it could go into both, but we're very happy to have Larry and team on the technology side because they've been doing exceptional work scaling that business.
How's it been difficult just because you're going through a rebranding or a an evolution where you're putting maybe some of the companies that initially were you invested out of the Catalyst fund, now technology fund, and kind of understanding that they're more on the growth now consumer fund. How has it been with expressing this, or do you have to talk to your LPs about kind of some of this reshuffling that's happened, and how has that gone?
100%. I think, and listen, it was kind of a clean break. Although we're doing the rebranding now, it really occurred when we raised Fund 2, which we closed in February of 2022. And so Fund 1, you had a mixture of direct-to-consumer brands, software businesses, and marketplaces. That was a $250 million fund. Really focused on Series A and Series B. When we went to market for Fund 2, we were kind of very clear with our LPs that we were moving this to be software and marketplace focused, and we were going to raise $400 million to also be stage agnostic. And so primarily we will invest in the Series A and B, but we're also happy to invest in the growth stages as a co-investor in market leaders that are really impacting VMG's consumer ecosystem. And so where we've kind of moved and communicated is this idea that they weren't stacked like some of the traditional venture where you have kind of early stage VC and then you have your growth fund and there's a ton of overlap. Fund 1 and our consumer practice were more like kind of this, where there was some overlap but not a ton. In Fund 2 and growth or consumer Fund 5, we really moved for them to sit side by side, where this side on the technology side is all really helping build better businesses on the consumer side, and the consumer side is helping influence the decision making on the technology side. And so they're kind of working very hand in hand, but there's not really any overlap in the types of businesses we will invest in.
That's helpful. How do you also think, because I know that the VMG ecosystem gets brought up a lot, and I know when Wayne was on, he talked a lot about it as well, about the VMG ecosystem. How do you maximize that ecosystem, where I understand on the technology side, you're investing in companies whose target customer is our brands, right? In that they are maybe e-commerce infrastructure companies, or they are, retail infrastructure companies. How do you think about making potential introductions? Because I'm sure you don't want to be too pushy. And how do you kind of navigate that in terms of maximizing your ecosystem, but also not pushing hard heavy on maybe some of your consumer portfolio brands of, hey, you need to use kind of this technology or this is how it could be helpful?
Yeah. No, it's a great question, and one we've thought long and hard about, because you often lose trust when you're solely pushing things that you have a vested interest in. And I think we actually started walking the talk here on before we even had technology. And so some examples of this in the ecosystem that Wayne probably alluded to is when we have retail symposiums that we help host for Walmart, Target, Kroger, Amazon, whatever it is. We're very careful that we're inviting a lot of emerging brands that are in our competitors' portfolios that are haven't received funding. And we definitely invite some of our brands too, but it's never pushing solely our business or our portfolio companies where you feel like, can I really trust what these guys are saying, because it seems very self-interested. But trying to take the long-term approach that, if we support the emerging brand ecosystem on the consumer side, like, it will come back to help us, either because we'll have more stronger relationships with these retailers who will give us more insights, or when we really do need to push a favor because we really believe in a business, we can have that conversation with those retailers. As it applies to technology, listen, a big part of your diligence is doing market landscape and competitive analysis. And we're trying to figure out why we prefer to invest in a company, in a particular company versus its competitive set, and why. And how we originate thematic or thesis work on our end is hopefully listening to this ecosystem, understanding its pain points, or at least understanding what types of technology solutions they're looking for. A brand that a lot of people have probably heard of on our technology is Attentive, which is the SMS platform, right? I think you were seeing a lot of saturation within email marketing. iOS 14 changes were happening, and people were looking at other effective ways to reach consumers. When we spoke to our portfolio companies, we didn't just say, "Hey, you guys need to check out Attentive." It was very much, there are a few businesses that we've started to really like in the space after doing a couple months of work. The top three that we think we've identified is, and this was, a couple of years ago, so it's changed a little bit today, but I'll pretend it's 2 years ago, was, Attentive, Postscripts, and Emotive. And, these are the reasons why we decided to invest in Attentive versus Postscripts and Emotive. Here are how they each pitch their value props. And, here's kind of what our thought is. Where do you want to, who do you want to use? And so obviously very much disclosing that we're investors in one of them, but there are multiple choices. And for some businesses, it might not be the right thing to go with Attentive. We just feel like for the majority of the businesses out there, it is. That type of feedback also, because for those who decide not to go to Attentive, we can then capture why, and hopefully then relay that to the team at Attentive and saying, hey, are there product gaps? Is there a segment of the market that is just not seeing the same value? Is that a market that we should focus on capturing or not? So it can be very beneficial, and then we continue to maintain that trusted relationship with that ecosystem where they're not like, oh, great, here's VMG who's just going to pitch more of their portfolio companies. But it's, if we've listened to the pain point, we understood what they're trying to search for, and then come back to them after doing a bunch of work and being fully transparent about the work we have done and providing that to them, it just saves them the hassle of doing an RFP. We've kind of done it for them and looped out the pros and cons of each solution.
Do you find yourself more per se like a top-down investor, in that obviously you're not a generalist, you're very much focused on, maybe e-commerce infrastructure, let's say, and maybe retail infrastructure in the on the technology side. But how do you think about like pain points or things you would like to see that are different or that needs to be different or changed that could be actually major investment opportunities? Does that mean that you're very thesis driven about a particular idea and then you kind of go and you find out which entrepreneur is kind of building the best product in your mind after you've done your diligence? Or it's a bit more bottoms up where um you talk to a lot of founders, you kind of understand what they're doing, and then you kind of go back and do your due diligence of if this is a real problem, um, and then get back to the founder if it actually makes sense for you to invest.
Yeah. So we're about 50-50 today. I think we want to continue to lean heavy into the top down. But listen, I think all of us also have great operator networks, and we hear of great businesses that are providing a really unique solution. So, we typically break our teams out into vertical focuses. Like, for example, you're really focused on marketing technology. You're focused on supply chain technology. You're focused on omni-channel or e-commerce enablement. And then we also focus on operational or department heads. And so, hey, you're building a network of CFOs in our ecosystem. You're building a network of COOs or operators. You're in marketing or e-commerce heads. And then, triangulating both of those into what are the biggest pain points that software can address. And that's that top down. But a lot of time when you're having those conversations, these same operators or portfolio companies will say, well, we just actually implemented X, Y, and Z solution, and it's having an amazing ROI. You guys should check this out. That's more of the bottoms up motion where, okay, we've heard of a business through that ecosystem. Then we're doing the work. Okay, how broad is this pain point? And let's present this to more operators in our network to see if this is also solving the same need for them as it was to the person that presented the idea to us. The truth is that there's always going to be some opportunistic, and it's a little bit of, probably 50-50 today.
Then on the kind of thesis driven top down, what would you like to see and that you're really interested in changing about kind of e-commerce and the customer experience?
So as it relates to e-commerce specifically, I think historically a lot of solutions have been purpose built for that one vertical. And so, the Shopify marketplace, for example, was a great way that encouraged a ton of innovation, a ton of entrepreneurs to build point solutions for e-commerce. I think what we're really excited about going forward, come back to where we started with, is that we believe the successful brands of the future are going to have really strong omni-channel capabilities. Is to mirror e-commerce with offline and have more solutions that not only are integrated with your e-commerce strategy but also your retail or offline strategy. A good example of this is like even inventory management systems. Very few inventory management systems work well across both channels. And going forward, we think that will be as increasingly important. Order management system, IMSs, even ERPs. I think that is a really exciting opportunity. I think there's been also just more innovation in terms of consumer journeys and data and abilities to interrupt the consumer decision-making process online. But we're excited about how do you replicate some of those tactics offline. Drew on our team is kind of dubbing the offline cookie, but it's how do you provide some of these really efficient journeys in real life. And there's more and more technologies that are being built for that, where certain consumer segments like food, the vast majority of the sales are happening offline and in person. And so what do those retailers need to effectively improve the customer journey?
No, that's helpful. Like as well, how if you do, online marketing, how can you see maybe the attribution from that, in sales? I mean, in retail and kind of offline, and be able to actually make a further connection between the two, because
And because like even like the data sources are very disparate, and so you kind of have, if you look right, you have IRI, Nielsen, a bunch of offline data sources, and then you have 1010 Stackline, a bunch of others on online, and so you kind of have these two data sources. How do you bring that all together? And are there increasing even data plays? That really show you the complete picture of your business. And I think that's going to be helpful for the next generation of consumer founders, is being able to take that holistic view and make decisions, because when during COVID you wanted to shift all of your spend to e-commerce. Well, now, especially as Facebook and some of these other acquisition channels have become a lot less capital efficient, you want to move a lot of your dollars to other retailers or other large marketplaces rather than your own. And so you're gonna, and it's gonna revert at some point. And so you're just gonna need the capabilities of both, and figuring out where you're going to get the strongest ROI for that next dollar spent by channel. And I think that's something we're really excited about.
No, totally. That, yeah, innovation, like innovation within customer journeys, as you say, and kind of the data behind it, and whether, and because I mean, it kind of goes back, and maybe this was part of maybe the evolution too of VMG, but it's really hard for especially for CPG businesses, to actually work online, just because you usually make your money in pallets rather than single order, right? Or in boxes, right? So it's really hard when you don't when you're not actually selling kind of that volume that you're able to do, kind of in retail, online. So like the economics are just really tough. And so how can you still leverage e-commerce for your business rather than leverage e-commerce for your business, or even as a marketing channel, and actually maybe convert customers in stores, and also see the data between those two?
No, I mean, I think this industry is being shaken up. I mean, I've been with BMG now 11 years, and how much it's changed in those 11 years is crazy. And I think historically, I think you could utilize the same playbooks that the business that had come before you utilized. That's just not the case anymore. And I think that's where we felt building the technology capability in-house was critical, because that for us to be the best consumer investors going forward, we would need to identify the best tech stacks for these businesses to utilize to, again, continue to drive efficient growth and profitability. And again, we feel like we're just now at the beginning of that adoption curve of technology within a number of these consumer verticals. And we're really excited about the adoption that's yet to come. And can we be some of those early investors that will see that and ride that adoption curve, as this industry will just be forced to invest more and more into technology.
Yeah, and I do think it's also interesting, just as a trend in venture capital, where you had, a lot of maybe tech investors pouring money into, digital native brands, right? And then of course, for the most part, you know, um, only kind of few actually performed to like kind of the level of expectation, to what they wanted, just because I mean, and I'm sure we could talk about this at length, because of all the differences investing in consumer brands versus technology, and maybe D2C brands were thought of as technology businesses rather than using technology as a distribution channel. But I think it's kind of interesting. There seems to be a wave now of consumer investors too, going towards and investing in underlying technology as well, and kind of going the backwards way per se from it. So I do think it's and so it is kind of interesting. I appreciate how VMG kind of has actually kind of have two different funds and various kind of clear, even though it's one VMG, it's kind of very clear in terms of what the funds do. Because also I feel like there are consumer funds where it kind of is just all pocketed and they invest in consumer, but then they also invest in, B2B kind of SaaS businesses that where their customers is consumers. That's pretty cool.
I think the underwriting process, to what you alluded to earlier, is quite different, and that's where we felt, we had a lot of debate. Does this fit into one fund or two funds? And I think given the just the overall underwriting process and the competition is different, and the way at which deals are conducted is different. We just felt that we needed a dedicated fund, and we needed investment professionals that were used to that day in and day out versus going from investing in a growth stage consumer business that had 20 million of EBITDA to a technology business that was burning $1 million a month.
Yeah, no, that's a great point. How also geographically have you, I always think that, consumer businesses can really be built from anywhere. And I'm sure that there's, there are multiple examples of consumer businesses being built in small towns and what have you. Technology, for the most part, prior to COVID, it's been mostly, I would say, like the main, like the coasts and, maybe certain pockets, between the coasts. But for the majority, it's, kind of where the engineers and the talent is, with regard to it. How do you think about geographically building? Because you kind of went from on the consumer, like pure kind of consumer CPG, where, again, I think, and I love your perspective, you can build like a CPG business from anywhere, to a, building technology. Do you think about geography at all when it comes to building tech businesses, or not so much? Maybe there's no difference.
No, I mean, I think you nailed it. It's just, I think COVID changed a lot, because I think you're also just seeing more remote teams now than ever. I think you're seeing engineers not all gravitate towards the Bay Area or New York. I think you're seeing strong pockets of engineering talent in a lot of cities, and so no, I don't think we are too geographically specific. We'll look at North America. So we've invested in a couple of businesses in Canada, where I think there's actually a lot of strong engineers. In both coasts, some in Texas. Yeah, I think you're going to see it more geographically dispersed. And we've done a few investments in Europe, where there's some really strong talent too. Primarily focused on North America, and honestly, I think we have an office in San Francisco and New York for a reason, because we still feel like a lot of those businesses are being built in those geos. But we get on airplanes all the time and find a lot of businesses that are not in California or New York.
That's helpful. What's one book that's inspired you personally, and one book that's inspired you professionally?
Ooh, that's a good question. Well, I guess I could give you two books, but it's funny. I think they both have, similar takeaways that do both work across personally and professionally. It's just maybe because I just like both of them a lot. Unbroken and Shoe Dog. And I think, resilience and persistence is critical to success. And no journey is easy, either personally or professionally, and you're going to hit a lot of bumps. But to the fact that you have the grit to persevere and be resilient, you can find great success, or you can continue to survive. And so, how do you stay positive when you're going through turbulent times. And I think that positivity will allow you to get through that. But then also, how do you stay focused on your ultimate vision and goal, and making sure that you understand it's not going to be an easy path, because no journey is, and just get some comfort and positivity in the fact that no path is easy.
No, I appreciate that, Carl. We'll definitely add this to the book list. Shoe Dog is like the #1 most recommended book on this podcast, and that's great.
That's funny. And now I guess Unbroken, they have a movie. So for those who don't like to read, you can even watch the movie.
Totally. Well, Carl, thank you so much for your time. I really appreciate it.
No, thank you, Mike. Great to speak to you.
And there you have it. It was such a pleasure chatting with Carl. Carl, thanks again for coming on the show. If you're loving the show, highly recommend subscribing to the newsletter at theconsumervc.com, where you'll get all new episodes straight to your inbox and a weekly recap of all the consumer deals that are happening. Thanks for listening.